Friends, we make a beginning with the new topic, capital gains. Capital gains happens to be the fourth head of income. Before I get into the topic of the capital gain, let me explain the peculiar features of this particular head of income. First peculiar feature is what? Before we start any head of income, we should understand first what is the charging section says. Salaries topic gets started with which section? Section 15. And what the charging section in the salary says? Income under the head salaries will be taxed either on your receipt basis or on accrual, whichever is earlier. Then your income from house property gets started with which section? Section 22. Annual income of the house property and how to calculate the annual income. Then profits and gains from business and profession gets started with section 28. And your income from other sources gets started with which section? Section 56. So in all those four heads of income, there is only one charging section. Whereas your capital gains, you have got two charging sections. One is section 45 and another is section 46. Then another important thing is method of accounting. It is relevant for only two heads of income. One is profits and gains from business and profession. Second is income from other sources. For rest of the three heads, that is salary or house property or the capital gains, your method of accounting is not having any relevance. How come? You can't say to the income tax people, I am on a cash basis, so my salary income I am accounting only on cash basis, so on accrual basis I am not going to pay. Can you say like that? No, because your charging section says salary under the head income from salaries is going to be taxed either on receipt or on accrual, whichever is earlier. Similarly, under the head income from house property, irrespective, yes, actual rent is one of the criteria, but that is not the sole criteria. Municipal rental value, fair rental value, stamp duty, that is standard rent. These are all the things to be considered before you calculate what is the annual value. There also your method of accounting is not having any relevance. So also the capital gains. Friends, try to understand. You should be very careful when you make sale of the capital assets. Don't make sale of the capital assets on credit basis. Of course, it is always better any human being live only on cash basis. But if I say when I am doing business, cash and carry, I don't do business on credit basis, probably my competitor may be doing on credit basis, so I am losing some business. So in order to attract, yes, I am forced to do the business on credit basis also. But capital assets, kindly don't do it on a accrual basis, because on one hand there is a chance that after you register the property on the name of the other person, probably he may never come to you and make the payment. And there is no concept called as bad debts under the head capital gains. Second thing is, the moment you transfer the property, your charging section of section 45 says what? You are liable to the capital gains tax. It won't allow your arguments that, no sir, I sold the same to my friend Krishna Reddy and I know Krishna Reddy is a very sincere human being. After 5 years he wants to pay. So as and when he makes the payment, I am going to make the payment of the tax. Will the law will accept it? No. So these two things are very peculiar to the topic of the capital gains. One is it has got two charging sections, section 45 and 46. And second thing is, method of accounting has got no relevance. How you are accounting for your capital gains income has got no relevance when it comes to the point of the taxation. So this particular chapter is being spread from section 45 to section 55. Section 45 and 46 are charging sections, and that 46 section is a peculiar section. On one hand it is a charging section, on the other hand it is a section which says it does not amount to transfer in the hands of the companies. Of course, what is section 46? I will come to that as we proceed in the topic. Section 47 deals with transactions not to be regarded as transfer. Section 48 discusses about how to compute the capital gains tax other than depreciable assets. Then you have got section 49 which deals with the how to ascertain the cost of acquisition. Then we have got section 50, 50B, 50C, your stamp duty valuation, slump sale, sale of depreciable assets, how to calculate the tax, then sale of depreciable assets by the power sector undertakings. These are all being dealt there. Then of course we don't have 52, 53 and all that. 54, as all you know, deals with the exemptions. 55 reference to the valuation officer, like that. Overall you should have an understanding of, in this particular chapter, each section deals with what. So to start with, today in this particular session we try to analyze the charging section of section 45. See, we also need to read the definitions. Yes. Friends, please remember, in any law, whether it is company law or bonus act or gratuity act or income tax act, definitions are given in which section? In section 2. Right? Section 2 gives the definitions. See, one more important thing as a law students you should remember is why you should read carefully the definitions, more particularly in income tax law. See, is the law is defining pen, pencil, whiteboard, camera, light? No. Law understanding and dictionary understanding are one and the same. But wherever the law want to either extend the dictionary understanding or condense the dictionary understanding, it is the bounded duty on the part of the lawmaker to necessarily define that particular item. To tell you about agricultural income is an exempted income. And agricultural income, anybody can tell what constitutes agricultural income. Then why law specifically defined the agricultural income? Because we are living in a country called as India, where so much intelligence and intellectual capacities are there. What happened is, there is an interview in the State Bank of India from clerk post to the officer post. Then the interviewer asked the person who came for the promotion, why we should give you the promotion? Then that gentleman says, sir, I got agriculture. If you got agriculture, why we should give you the promotion? 2-3 times he said, I have got agriculture. Then the interviewer asked, can you be more clear on that? Yes sir, I have got a culture to agree with my boss. That helps for smooth functioning of the organization. So that's the reason why you have to give me the promotion. So what you are thinking as agriculture, what I am thinking as agriculture are different. Continuing with the story, if we allow such kind of gentlemen to continue their argument, they may say even salary income is also agricultural income. Because that gentleman may tomorrow argue that Yes, unless I agree with my boss, he will not give me the salary. Since I am agreeing with my boss, I am getting the salary. So boss, I am, according to me, this is also agricultural income. So there are people like that who are going to, what is it, cruelly analyze, cruelly take the benefit in the absence of clarity being given by the law. So to put an end to such kind of arguments, necessarily law need to define agricultural income. So my point here is, as a final student, you should be well versed with the definitions pertaining to this particular head also. You should understand what is a capital asset and what is a transfer, because your charging section of section 45 says what? Income under the head capital gains arises when there is a capital asset and such a capital asset has undergone a transfer. So if you want to avoid tax on any capital gains income, you should see either the asset which you are transferring is not a capital asset, or that particular transaction does not amount to transfer. Any one of these things happens, then it is not subjected to the tax. Friends, try to understand what is our law of taxation. All revenue receipts are taxable unless and otherwise they are being specifically being made exempted. And all the capital receipts are not taxable unless and otherwise there is a enabling provision to tax those capital receipts. Otherwise, normally corpus donations, they are capital receipts. We are not subjecting them to the tax. So capital receipts to be taxed, necessarily there should be enabling provision to say that this is a taxable. That's where we have opened the topic called as capital gains. So your section 45 says what? Any profit and gain arising from transfer of a capital asset. So the two things are important. One is a transfer and another is what is to be transferred is a capital asset, and such a transfer must be effected during the previous year, and then it shall be chargeable to the income tax as the income of that particular previous year in which the transfer takes place. Now this gives rise to the point of you should understand what is a capital asset. Yes, capital asset, which section defines capital asset? Section 2, clause 14. Friends, please remember, direct taxes, when you are studying at the final level, you have already studied this particular subject at the PCC level. So sections and these definitions I am not making you to write. Only points where they are very much relevant, I am asking the students to please make note. Other way around, you generally can listen and can read from your study material issued by the Institute of Chartered Accountants of India. Now capital asset, section 2:14 says what? Capital asset means property of any kind. You should be very careful while reading the definitions. Capital asset means property of any kind held by the assessee, whether or not connected with his business or profession. So capital asset is property of any kind. That means it could be a movable or immovable, tangible or intangible, held for the purpose of business or profession or not. It constitutes a capital asset. Now the point here is, what are the specific exclusions from the definition of the capital asset? First exclusion is a stock in trade. Why stock in trade is excluded from the definition of the capital asset? Because on making sale of stock in trade, what the income you are going to get is subjected to the tax under the head profits and gains from business and a profession. That is the reason why stock in trade, although is an asset, is being excluded from the definition of the capital assets. Second thing is personal effects. try to understand this is a very important area, that is, your understanding should be very clear. When I say personal effects, please do remember it is only of movable property that is being excluded. What my point is, let us suppose Chakravarti is having a building which he is using for his personal purpose. He is so intimately using. Every day he sleeps. Every day he takes bath in that particular premises. So that means he is intimately using. Then can we say it's a personal effect of Chakravarti and it's not a capital asset? No. What is the point? Capital asset means, that is a personal effect means movable property. Let us suppose Chakravarti is having a car, motor car. It's a movable property. Once he makes sale of that particular motor car, then it is not subjected to any capital gains. Of course, friends, in case Chakravarti is a dealer in cars, that is, he purchases the cars and makes sale of the cars, then in that situation it is a stock in trade, and what the income he is going to get is subjected to the tax under the head business income. Now, what is treated to be treated as a personal effect, I explained. But to the exclusion, another exclusion is there. That means, although they are personal effects, although they are being intimately used, still they are to be considered as capital assets. What are they? Jewelry. Let us suppose Chakravarti is having a very big gold chain. He is going to put that. Suddenly he is in need of money. He is making sale of that particular gold ornament. Then can he say, no, it is a personal effect, so it is not a capital asset, so no capital gains will arise? No. Because jewelry, although a personal effect, is still considered to be a capital asset, is a point. Similarly, archaeological collections, drawings, paintings, sculpture or work of any art, these things, although they are personal effects, are still to be considered as a capital assets as a point. And then friends, agricultural land situated in India is a point. Agricultural land situated in India. So, in case if agricultural land is there in the Nepal, still it becomes a capital asset and it will be subjected to the capital gains tax. And of course, it is only theoretical interest that gold deposits issued under the gold deposit scheme 1999, they are also being specifically excluded from the definition of the capital asset is a point. So now, in this context, what is the important point that you need to make note? Kindly make note of it. That is, capital asset excludes number one, stock in trade. Stock in trade. Held for the purpose of business or profession. Number two, personal effects, that is movable property. C, agricultural land situated in India. Agricultural land situated in India. Right. Next. One more point. Immovable property. Next point. Immovable property in which the assessee resides is not a personal effect. Why, friends? Because already we discussed that personal effect means only movable property. Next point. Jewelry used for personal purpose. Jewelry used for personal purpose is excluded from personal effects. Is excluded from personal effects. That is, it is to be treated as capital assets. That is, it is to be treated as a capital assets. Movable assets used for the personal purpose, let us suppose television fridge, these things, they are not treated as a capital asset. So what will happen? On that any income arises, that is not subjected to the capital gains is a point. And for that matter, it will not be taxed even under any other head of income also, because basically that is a, what is it, capital receipt. By making sale of a capital asset, what you get is a capital receipt. Already we discussed the point. For a capital receipt to be taxed, there must be an enabling section in the law to tax it as a point. As far as stock in trade, I already explained, it will be on sale of it, whatever the income comes, that will be taxed under the head profits and gains from a business and profession. Now, having got an understanding of what constitutes a capital asset, now we should move to understand what constitutes a transfer. Because why we are giving relevance to these two definitions? Because your section 45 says for a particular profit or gain to be taxed under the head capital gains, there must be a capital asset and it must have undergone a transfer. What is a transfer? Section 2 clause 47 defines what is it? A transfer. Friends, in this context, try to understand, already I explained the need for reading the definition, because in the absence of law defining what constitutes a transfer, people can make so many manipulations, right? Because normally transfer, layman understanding is what? Sale of an asset amounts to transfer of an asset, right? But there are many things which the law want to treat it as amounting to transfer. So that's why you need to read carefully what is a transfer. Transfer includes, I think all of you are aware that there are three kinds of definition. One is inclusive definition, second is exhaustive definition, third is a partly inclusive, partly exhaustive. Any definition we keep it in the including, which starts with includes, is an inclusive definition, because if the law at a different point want to add some more points, it has got open ended, and similarly if anything has got similar characteristics, it can be well brought into this particular definition. If that kind of situation is there, we will start any definition with includes. So your transfer definition also starts with includes. So transfer includes what? Sale, exchange, barter kind of thing. Barter means what? I give my pen to you, you give your calculator to me, right? Even in this also amounts to a transfer. Sale, exchange, third is relinquishment. Fourth is extinguishment of a right, relinquishment of an asset. Fourth is extinguishment of a right in the asset. Please be careful while reading this. As far as relinquishment of an asset. As far as extinguishment extinguishment of a right in the asset, not extinguishment of the assets. What is relinquishing and what is extinguishing? All of you, are you clear with that? Let us suppose this pen is there. Just to make you to feel it, I am giving this example. This pen is there. Voluntarily I am giving like this to Mr. Krishna Reddy. This is called as a relinquishment of the assets. Forcefully he pulls this from my hand. Extinguishment. What I am trying to convey to you is, extinguishment is something which happens with operation of the law. See, our beloved student Krishna Reddy today says, sir, I lost my cell phone. But all of you know what is the real story? One day his father scolded him. So while coming in the bus over the tank bund of Hyderabad, he has just thrown the cell phone in the tank bund. Now friends, tell me, is it extinguishment? No. Just like that he has thrown it there. Asset itself is lost. Asset itself is lost is not extinguishment. What we are discussing here in the context of extinguishment, for the purpose of the law, extinguishment of a right in that particular asset, not the extinguishment of the asset itself. That is, extinguishment of the right means SSC lost his right with operation of the law. Preference shares got redeemed. That amounts to what? You have your rights in that particular asset got extinguished is a point. So relinquishment is something which need to be happened voluntarily is a point. But what you can relinquish, Mr. Krishna Reddy? What you possess only. Because on one day what Krishna Reddy said, sir, I am going to give up my right over Charminar of Hyderabad to you. Being a citizen of Hyderabad, I am having a right in that particular Charminar, so I am giving up my right to you. Will it amount to relinquishment? No. Because for you to relinquish, Mr. Krishna Reddy, you should possess it. Right? Now, so transfer includes the sale, exchange, relinquishment of the asset and extinguishment of a right in the assets. Next, compulsory acquisition. What is it? Compulsory acquisition is a point. Because unless the law says that transfer includes compulsory acquisition, what will happen? Our beloved SSCs will argue in what way? I never intend to transfer. Forcefully government has come. Padma Plaza, from where I am delivering the lecture, is in the heart of the Hyderabad city, Amirpet. In this byline, government wanted to extend this road 60 feet this side, 60 feet that side. Then where my building goes away? Yes. On one hand, already I am crying, stating that it is being compulsorily acquired. On the other hand, income tax fellow says, yes, Mr. Chakravarti, this amounts to transfer, kindly pay the capital gains tax. Then naturally, I will go to the court. So to put an end to such kind of the drama, law specifically stated that transfer includes that is a compulsory acquisition. So now once it is stated clearly in the law, nobody can go to the High Court and Supreme Court. Friends, please do remember, many a time amendments in the law are only made to see that what is a well settled case at Supreme Court, it gets nullified. That is, poor SSAs will fight till Supreme Court and win a case. Then income tax department will go and cry before the finance ministry, and the finance ministry will bring in a the next budget session an amendment. Of course, in a civilized society, amendment prospectively is okay. Retrospective amendments, please do remember, in my opinion, are the criminal acts being done by the government on the citizens of India. Because based on the existing law, I plan my affairs. And if you suddenly bring an amendment with a retrospective effect, are you not troubling me? Of course, this is one way of lookout. But what the government says, Mr. Chakravarti, you are correct. It is a criminal act on the part of the government to bring a retrospective amendment. But why we are making retrospective amendment? Because the intelligent SSEs are making too much of the analysis of the law and trying to find out the loopholes in the law and try to take benefit of that particular loopholes. So there only we are bringing the amendments with retrospective effect. So as a advice to the future chartered accountants, let me tell you, try to understand the purposive intent of the law. Don't try to defeat the purposive intent of the law. If you try to defeat the purposive intent of the law, please remember amendments will come with a retrospective effects. Right? See, I'll tell you a small example here. I think at the PCC level you all might have studied the point that is business loss cannot be set off against the salary income. But such an amendment is brought in the law only 4-5 years back. But the income tax law which we are discussing is of 1961. From then to the past 4 years, there is no such a concept called business loss cannot be set off against the salary income is a point. But too much of a group mechanism, group planning made the lawmaker to say that no, business loss cannot be set off against the salary income. Because what happened? That is, the major income tax chunk will come from the salaried class. One tax consultant advised the people in Singareni College that you all come, I will get refunds to you. For each SSE he has put on paper business and created the business loss and set off that particular business loss against the salary income, and every employee of the Singareni College got the refunds. Suddenly income tax people on one fine morning when they saw the refund checks, crores of rupees are going as a refund check to the Singareni College. Then they just made an inquiry, how is it possible? Then they found every employee has got a business loss and that business loss is set against the salary income. That made them to bring a amendment in the law to say that business loss cannot be set off against the salary income. Thereby even a genuine person also suffered. So as a future chartered accountants, try to understand the purposive intent of the law and never try to advise your clients so that you defeat the purposive intent of the law is a point. Right. Coming back to the transfer definition, what we studied is transfer includes sale, exchange, relinquishment of an asset and extinguishment of a right in an asset and compulsory acquisition of the asset under any law. Then friends, capital asset being converted into stock in trade also amounts to transfer. Other way around, every fellow what he will do, that is, if he makes sale of the capital asset, if he gets capital loss, that capital loss will not be allowed to be set off against the business income. So what he will do, he will convert the capital assets into stock in trade and then make sale of it and then create a loss, which loss will be allowed to be set off against the business income. So to put an end to such kind of dramas, law clearly stated that if your capital asset is converted into stock in trade, that also amounts to the transfer. Even when you don't make sale of the same to the outsider, still capital asset getting converted into stock in trade will amount to transfer. Of course, thanks to the law, that only when the SSE makes sale of such stock in trade, that is the year in which this particular capital gain will become taxable. Normal rule is what? The year in which the transfer takes place, capital gains will be calculated and will be treated as the income of the previous year in which the transfer takes place. But in this particular situation of capital asset being converted into what is it, stock in trade, transfer takes place in the year in which capital asset is converted into stock in trade, but charging of such capital gains will be only in the year in which such a stock in trade is sold to the outsider. Then friends, we have transactions in the immobile properties which are being covered by the section 53A of Transfer of Property Act. See, what is the point here? Understand before you go through the legal sentence construction and all that. First, try to understand, myself and Krishna Reddy are very good friends. What is happening? I made sale of a particular property to Krishna Reddy. I am an old man, let us suppose, of 80 years. How many years? 80 years. I am making sale of my property to Krishna Reddy, who is 40 years. Now Krishna Reddy says, sir, you and me are very good friends. Let us not complete the registration process. Then immediately I asked Krishna Reddy, why such thing should happen? Krishna Reddy, what is the benefit you are going to get, I am going to get? Sir, if it is not getting registered, what will happen? Property will be in your name only, na? Once property is in your name, you are not subjected to the capital gains tax, na? Once the property is not coming into my name, I don't need to offer the income from house property, na? Both of us are at advantage, na? Then I asked, I am 80 years, if I die, my children may say, dispute that my father never made sale of that particular property to you. No, no, sir, I have got full confidence on your kids. So let us do that. Now the problem is what? Will the income tax department will be standing before my door or his door and wait when Mr. Chakravarti is going to complete this registration process, then we will ask the Chakravarti to pay the capital gains tax? No. To put an end to such kind of things, law clearly says that transactions involving allowing the possession of immobile property to be taken and retained in part performance of the contract referred under section 53A of Transfer of Property Act amounts to transfer. That means here what should happen for a particular thing to be brought as a transfer here? First I should enter into an agreement, then I should allow the other person to take the possession of the property, and he already paid the amount to me. Only thing that is being not done is the registration. So since it is not being registered, it will not postpone my obligation to what is it, pay the tax is a point. Then one more thing here is like any act which will allow other person to be the person who can enjoy the property also will amount to the transfer. See, what is the point here? We are 10 chartered accountants. We formed a society. All of us contributed to the society, right? Society constructed the flats. Being the members of that society, we are allotted one flat. Who is the legal owner of this particular flats? Society only. But who is the beneficial owner of this particular flats? We are. Right? Now the point here is like in Hyderabad, many places registration will not happen. Through power of attorney only things will shift from one hand to the other hand. So all those power of attorney transactions which will enable the other person to enjoy the possession of the property will also amount to the transfer. Similarly, people intelligently may say, I am giving this particular property to Archana on a 99 years lease. इसका मतलब क्या है? 99 years के बाद कौन रहता, कौन जीता, कौन मरता, मरेगा. तो point here is such kind of too much thinkings are put to an end by saying that all such kind of acts will amount to the transfer is the point. And the maturity or redemption of the zero coupon bonds. So what is very, very important from your examination point of view here is compulsory acquisition amounts to transfer, conversion of capital asset into stock in trade amounts to transfer, then relinquishment of an asset amounts to transfer, extinguishment of the asset amounts to transfer, and transactions wherein possession is handed over of the immobile property, in part performance of a contract wherein registration has not happened will still amount to the transfer is a point that you should remember. Now, in this context, having discussed what is a capital asset and what is a transfer, I would like to discuss with you certain issues. Of course, only when that issue is so relevant from the examination point of view, you can make note of it. Otherwise, carefully listen. Whether capital gains arises on sale of silver utensils. See, silver utensils, they are personal effects, does not come under the jewelry. So, once it is a personal effect, then no capital gains will arise is a point. Gold bars and sovereigns. Of course, gold in the present context when we are discussing, of course, at the time when we are discussing, we know a person who sleeps on a bed made of gold, who sits on a chair made of gold, right? Obulapuram. Right. Now that gentleman, let us suppose, is using the gold bars in the puja place. Can he say it's a personal effect? No. Gold is a jewelry, so capital gains do arise is a point. Now, gold utensils are not a personal effect because gold comes under the jewelry and jewelry constitutes a capital asset is a point. Redemption of preference shares, will it amount to transfer? Redemption of preference shares, will it amounts to the transfer? Yes, because the redemption comes under what is it? Extinguishment of an right in that particular asset. That is relinquishment of a right, not extinguishment, relinquishment of the right in the asset. Please make note. When preference shares are redeemed by a company, when preference shares are redeemed by a company, shareholders has to abandon or surrender, his rights in the shares, his right in the share in order to get the money. In lieu thereof. Thus there is relinquishment which amounts to transfer, resulting in capital gains. Resulting in capital gains. Friends, when I am explaining this particular transfer, please make note of one point in your mind. When we say agricultural land is excluded from the definition of the capital asset, which agricultural land? Is it rural agricultural land or is it urban agricultural land also? Necessarily it should be a rural agricultural land. When we say rural agricultural land, what means rural agricultural land? Of course, when you studied the agricultural income, you have studied the agricultural income. It should not be within the limits of the local municipality, and it should be away 8 kilometers from the limits of the local municipality, and all that you have studied is a point. So please do remember, by transfer of urban agricultural land, still it amounts to the transfer of a capital asset attracting the capital gains. Of course, if a urban agricultural land is going to be compulsorily acquired, then there is a exemption section. As we proceed in the topic, we will discuss that particular situation. Other way around, only by transfer of a rural agricultural land, whatever the gain that you are going to get is not subjected to the capital gains, whereas if it is a case of urban agricultural land, definitely it will attract the capital gains. So just make note of that as by sale of urban agricultural land, by sale of urban agricultural land, SSC will be subjected to capital gains as urban agricultural land constitutes a capital asset. So what is excluded is a rural agricultural land, that also situated in India, right? Then let us suppose I am exchanging the shares of one company in lieu of shares in the another company. Will it amount to the transfer? See, the definition of transfer says a transfer includes exchange. Of course, in case of amalgamation, as we proceed in the topic and we read section 47, what does not constitute the transfer, there we say in lieu of amalgamation, if you are making a exchange of the shares of the vendor company in lieu of the shares which you are getting from the purchasing company, that does not amount to the transfer and all. But other way around, generally, if other than amalgamations and all, if you go for exchange of shares in one company with the shares in the another company, that amounts to the transfer is the point.